Well, hello traders, and welcome to today's session. Today's video is specifically for beginners. You probably want to start forex and you don't know where to begin, what material to read. There's probably a lot online, so I decided to make this video just to give you an overview of the forex market. This is for a totally complete beginner. More information can actually be found online, but I thought it important to actually do this video, and I'll actually be doing a lot of these beginner videos, just taking you through the forex market from the definitions to how to trade, and even actually my strategy that I use, which is price action. So welcome, and I hope you learn something. Forex basically is the exchange of currencies, and we have two major market types. We have the spot market and the derivatives. The spot market is where currencies are bought and sold on their trading price. This is what you see in your typical commercial bank, like when you go to a counter and you have Kenya shillings, you want the dollar. That's basically spot. And actually, most banks in Kenya make their money through spot trading, and spot prices are affected by a lot of factors. Major factors being interest rates, macroeconomics, geopolitics, and price speculation. Interest rates, I'll give an example using the dollar. See, when interest rates affect return, let's say when the Fed decided to increase its interest rates over the period 2023, we saw a lot of flows to the dollar. Why? Because the dollar was actually moving from a period of almost zero rates to now current rates around 4.5, around 5%. So it means if you held dollars, you'll be earning more on a return point of view than in previous years. So we saw a lot of macro flows to the dollar, and same in Kenya shillings. If you offer high rates, like you've been seeing the central bank increasing its rates, if you look at the T-bills right now, the treasury bills right now are around 16%. So you'll see a lot of flows to the Kenya shilling, and actually that makes the Kenya shilling attractable, and this actually affects its pricing, makes it stronger compared to other counterparty currencies. And two, macroeconomics. Macroeconomics is basically the behavior and performance of the economy as a whole. Here you look at factors such as unemployment, growth rates, the GDP, inflation. These actually affect the risk rating of your country, risk rating of the sovereign basically, and this affects the price of currencies viewed by investors outside, also investors internally. Geopolitics, we are seeing what is happening across the globe, Israel and Palestine. We saw the Russia-Ukraine. We are seeing tensions between China, Taiwan, tensions between the US and China. All these affect risk appetites, and typically you will see flows to currencies that are deemed as safe havens. In today's world, the dollar is viewed as a safe haven. So when the market is in a risk-on environment, you see a lot of flows to the dollar. You see a lot of assets being converted to dollar. Like in Kenya, we saw a lot of foreign flows from our own stock market. Actually, it has declined significantly because it is largely dominated by foreigners as they went back home and just to store their assets in dollars, because you don't know what the future holds. And that's it on what affects spot prices. The other market type is derivative markets. In derivative markets, we have forwards and futures. In Kenya, we do not have futures markets. Future markets are regulated. They trade basically like how we have an NSE. So basically, you have a stock exchange for futures. In Kenya, we don't have that structure, but in the US, it's there. We have a futures commission that actually regulates trading of commodities. But in Kenya, we do have forwards. Banks do have products like swaps, which they offer different traders just to help them hedge against these interest rate risks and foreign currency risks. And I'll just give an example for someone who's new, just to understand the concept of forwards. Let's say I'm a steel manufacturer. My raw material is steel. I'm a steel wool manufacturer. Steel wool is a product that is used in many Kenyan families just to wash your utensils, particularly the aluminium and the steel utensils. Let's say I'm a company that manufactures this steel wool, and my raw material is steel. And this steel I source it from outside Kenya because we don't have it here in Kenya. And if I'm sourcing it out of Kenya, it means I'm using foreign currency to buy it. Let's use the dollar as an example to make it easier. We've seen in the past year the dollar rise against the Kenya shilling. So let's say anticipating a demand increase in the number of people who want to purchase steel wool in the coming months. So what do? To anticipate to meet this demand, I want to make an order for steel wool, for steel that is. And I see from me as the owner of this company, I see that dollar will be high in the coming months compared to right now. Right now it's around 160. Assuming hypothetical example, in the next month, I assume it's going to go to 165 or 170. So what do? I approach my bank and tell them, I want you to lock for me a rate. So I want you to lock for me the 160. So that means when you lock a rate, it helps your business survive the volatility of those price of that FX fluctuation. You're able to maintain your margins, especially when you're in a very competitive markets where a slight increase in the price of a good can keep you out of the market. So use these forwards to actually hedge against these interest rate risks. Now it's not completely risk-free. I mean, rates can go down. So imagine if locked in 160, then rates go to 150. You ideally make a loss on that transaction. But if rates go higher, let's say to 165, as I'd given the example, you'll be in a better position and usually be able to compete competitively in the market compared to a fellow steel wool producer who bought it at a spot price of 170 when you had locked in your 160 rate. So that's basically an introduction to forwards. More information can actually be found online. If you look at the global FX market in 2022, the average transactions were $7.5 trillion per day. This is according to the Bank of International Settlements. They actually put out this data. You can check them out. They have a website. Compare that to stocks, which does around $200 billion in volume per day. You can clearly see the FX market is really big from a volume perspective, and this means this actually presents you an opportunity to participate in it and make money out of it, because there's some sort of stability that you may not necessarily get from stocks, even in terms of predictability. Yeah, but this volume is concentrated in a few pairs, with the USD with the dominant pair, given it's the global reserve currency, basically our safe haven. And if you look at the average daily turnover of USD in 2022, according to the Bank of International Settlements, it was actually $6.6 trillion. And the reason why the dollar is dominant is, one, it's the main vehicle for FX transactions. Most FX transactions are made against the dollar, even here in Kenya. When you talk of FX price fluctuations, it's usually case to the dollar. We rarely talk about case euro, case pound. Yeah, it's also the main currency for offshore funding markets. Perfect example, the Kenyan Eurobond. If I float a bond in international markets, most likely it will be dominated in US dollars, because that's a currency that is used in most transactions and trusted by a lot of investors worldwide. It's very popular in a lot of trade and global payments. I mean, most of car prices in Kenya are affected by dollar prices globally. And this is the same for companies that import raw materials to manufacture goods to be distributed to local consumers. Even if you look at our FX reserves, usually dominated in dollars, even in Kenya. When you talk of our import cover, Swift payments basically a system that allows for international payments. Most international payments are made in dollars. Even when you are buying goods from China, most likely if you're in Kenya, it will be made in dollars. And this is just a graph, just give you a visual presentation of how big the dollar is. You can just look at these bar charts. These are stacked bar charts. You can see the dollar. If you look at the volumes of the dollar, high compared to the euro, pound, Japan. The RMB, this is the Chinese yuan, been growing in popularity over the few years because of the impact that the Chinese are having in the global macroeconomics. And others. Now others, these are your other minor pairs, exotic pairs, and I'll be deep diving these as we go through this presentation. And this is another visual from the Bank of International Settlements. If we look at the most traded currencies by value, the dollar controls close to 90% of the total value of currency trades in the world followed by the euro at a distance second, and the Japanese yen. Then we're seeing the pound, then all other currencies as they are over there. How about an introduction to currencies? In this section, I'll be taking you through the major, minor, and exotic currencies and the reasons why they actually classified that way. Why are they called the major? Why are they called the minor? Why are others exotic? The major pairs, you'll notice a trend. They mainly have USD in the name, and the major pairs are the euro, dollar, pound dollar, USD yen, the USD Swiss, the Audi USD, the USD card, and the New Zealand dollar. These are currencies I love to trade. These actually form core of my trading pairs. I also trade the major minors. Sorry, not major minors, the commonly traded minors, which are the euro pound, the pound yen, the euro Swiss, and the Audi Japan. Now, if you check the minor pairs, they don't have a USD per se, but they do have a combination of the majors. So like you see the euro yen, the euro Swiss, the euro pound, and you have exotics. These ones are rarely traded and don't even form a very big portion of world trading in terms from an FX perspective. And the differences between the three categories is largely split into liquidity, spreads, volatility, and risk. Liquidity is basically the current amount of cash in circulation of a particular currency pair. It's basically how easy is it for a currency pair to be bought and sold in the market. Right now, all commercial banks in Kenya have USD, but I'm not sure if you walk in and ask for a Canadian dollar, you'll get it in all banks. Even if you walk in and say you want the Chinese yuan, not all banks probably have it, but the dollar is a standard. You'll find a dollar, you'll find the pound, you'll find the euro. So basically, the more a currency is in circulation, the more liquidity is. And this actually affects its pricing. In FX, we use spreads as pricing, and this is basically the difference between the buy and the sell of a currency pair. So you find that the most major pairs are very thin spreads, followed by the minor pairs. Then the exotics are very wide spreads. They're very expensive to trade. And volatility is basically how is the price moving over time. If you look at the majors, the price is stable and the trend is usually predictable, is usually clean most of the time, and it respects support and resistance levels cleanly, unlike the minors and the exotics. The exotics are wild. The volatility over there is just crazy. I personally do not trade exotics because I cannot keep up with the volatility. Just goes up and down, up and down. The chart is not clear, the trend is not clear, does not respect support and resistance. It's just a mess. On the risk side, risk is just basically a measure of safety. And if you look at the major currencies, they tend to be more predictable and have low spreads compared to exotics. And this makes them less risky because they're used in a lot of transactions, unlike the exotics. Rarely you see the South African rand in a lot of transactions, even the Kenya shilling on a global scale in a lot of transactions compared to the dollar, euro, and the pound. So these reasons, basically liquidity, spreads, volatility, and risk, is what determines the classification of the pairs as either major, minor, and exotic, and also volume. I forgot to put volume. And we saw the dollar controlling close to 90% of the volume of traded markets. With that in mind, what are the trading sessions? Forex is basically a 24-hour market. If I'm in Kenya, especially for when you're in Africa, you're advantaged because most of the major sessions occur when we are awake. And the highest volume of transactions in FX actually occur during overlapping sessions. So what are the major sessions in FX? The forex market has three major sessions. We have the Asian session, the London session, and the New York session. The Asian can be further divided into Sydney and Tokyo, but just let's stick to the Asian session. The start time and the close times are in GMT. So for my Kenyan traders, the Asian session basically begins at 1 a.m. at night and closes at 11 a.m. in the morning. The London session will begin around 10-11 a.m. Kenyan time and close around 7 p.m. and 8 p.m. Kenyan time. Remember, Kenyan time is GMT plus 3. New York session will typically begin around 3 p.m., 3:30 p.m., 3:30 p.m. and end around midnight. So what are the characteristics of these sessions? The Asian session is characterized by a lot of low liquidity. The markets are usually ranging, and the spreads are wide during this time. And even if you look at the candle bodies of during the Asian session, they're usually small. The range of the candle bodies is usually very small. And the actively traded currencies during this session are the yen, the Australian dollar, and the New Zealand dollar. You go to the London market, one of the most highly traded sessions during the day. This is where you see a lot of reversals and trends forming. It's highly liquid. The volatility is higher compared to the Asian session, and we see now a lot of thin spreads because there's liquidity now in the market. And the best trades to trade during this session, the best currencies to trade during these sessions are the euro and the pound. The New York session, my favorite. Same as the London, we've seen a lot of activity, liquidity, and volatility. And here basically is a good time to trade the majors, especially if you're a day trader or a scalper. It is important to, when you're trading a session, trade the actively traded pair in that session. I don't think it makes sense to actively trade the yen in the New York session, unless you're trading basically a major like the USD yen. Yeah. So for day traders and scalpers, I probably encourage them to stick to the New York session and London session, especially the overlapping period. You really want to be checking price action during that time. Overlapping period is basically, let's say like London. I'll give an example. New York starts at 3 p.m. Kenyan time. At that time, the London session is running. So when the New York is starting and London is still running, that overlapping time, you usually see a lot as a spike in volume during that time as American traders are just getting into the market. And during this time, we usually see a lot of data releases, especially during the New York session. We have releases that can affect the market, at least change the direction for the day. We have things like employment data, we have inflation, but I'll be speaking more into the fundamental side of FX in my coming videos. Today I just wanted to take you through an overview